Welcome everyone to another video of Near Finance. Today we are going to talk about REITs, real estate investment trusts, in a rising rates environment. See if it's an alpha generator, see if it can beat the S&P 500. So basically a REIT is a company that owns, operates or finances income generating real estate. Usually they are divided by specialty, so you can go in tech, or specialty, or entertainment, or construction, office, storage, and so forth. So stay tuned. But before that, we need to understand again what Mark Meldrum in his Rings of Risk said. First, we're going to the market, right? The S&P 500. Then we're going to the sector, which will be real estate, right? And then we're going to the industry groups. So it will be construction or storage and so forth. And then we need to see if any of these beat the market. So let's see if interest rates going up actually benefit the market or brings it down. So this is the sectors that we want to show. Retail, we have these three names if you want to check them out. In apartments, basically apartment complexes that are renting, we have all these three names. In office spaces, we have these. Healthcare, which is growing a lot, we have these three other. Storage, probably have heard of Cube and PSA Public Storage, one of the biggest companies in the storage sector. Tech, we also have these three. We have also industrial, and we have specialty, which encompasses more like entertainment and those kind of businesses. Why is this so important? Because the price of real estate versus interest rates is totally an outlier this year. Look at the orange dot in the end of October 2022, so by Halloween, right? Here you have in the lower axis you have in your x-axis you have your interest rates from 2.10% and the price of real estate. So usually, as you can see, there's a big correlation between as interest rates go to the right, so higher, the price goes down. But here is the opposite, right? As interest rates move higher up, also the price of real estate is really high. So it makes it really tough for affordability. And that's why we believe that these REITs, as they are renting as companies that they receive their money based on renting operations, they should do well because companies cannot afford. So renting spaces or facilities will be beneficial. But we'll see. We'll check. So the purpose of this analysis is that you can see how we could have done this year in a rising rate environment against the market. So we probably see, okay, the REITs we already saw in the Rings of Risk. Okay, REITs could be a way to outperform the market. So we're going to see how we can optimize our portfolio to maximize the Sharpe ratio, and the possible range of expected annual returns for the given period is between negative 22%, which is 6% less than the S&P 500, or 25%, which will be an active return of around 41%. So why are rates so important in this environment? Well, in the first part, you have to understand that rates don't really affect much the supply of materials and stuff, but they do have a tremendous influence on rents and financing costs. For example, as rates go up, both the supply and demand start collapsing. Why supply? Because as you want to build, and first, when you are a builder, you cannot just build based on the cash you have. Usually these projects takes a lot of capital, right? To create a new commercial tower or a new healthcare facility or a new storage place. This takes time and money, so you're not going to speculate because you know your financing costs are really high. So the supply side, it goes down. But also in the demand side, we can see that companies might be like, okay, if I want to buy a new building, it might be hard to finance that. So we should go just into renting that building. So maybe here we need to see what did well and what did wrong. We believe, as we say, that as rates go up, rent should also be more, not affordable, but people cannot, or companies, corporations cannot afford to buy. So rents will go up. So income in this company should actually go up, depending also in the way they finance their operations. So we're going to see how we did. So the assumption is that all of this, we're not making exceptions. All of this have the same weight at 5%, and we'll see what that will do. So basically, what we see based on our analysis and the optimization is that we don't need any of those. We just need the three of these. And why? We're going to see why. So basically, you're saying if we had like around 50% in Omega Healthcare investments, 16% in Iron Mountain, and 35% in Vichy properties, we could have gotten a return of 25%. But that's extremely hard. We want to see how a regular person will have done this, and our theory is that they will probably underperform the market. Why? Because it's about management selection. So the provided portfolio, equally weighted, will have gone and negative 20% with a huge standard deviation, 24%. The one we chose, which is only these three stocks at this specific weight, will have provided a tremendous return, right? Around 20%, and with a standard deviation of 20. So in theory, your Sharpe ratio will be 0.77, which is pretty good. Your active return will be 34%, and with a tracking error of 12% in comparison to the S&P 500. Here you see, and your maximum drawdown of the S&P 500 was 23%. The portfolio that we provide is 28%, but your Sharpe ratio, your portfolio that is with the maximum Sharpe ratio is negative 10%. So it's extremely difficult, even though correlations are the same. So what does this mean? We are going to see why these three tickers actually did way better than the rest, and why it will be virtually impossible to only pick these three, right, in this specific order. Because if we want to see here, the Fission Frontier, in the Fission Frontier, which is here, right, the Fission Frontier, that's where we got our maximum return for the maximum risk that we want to take. See, all the names are all the way down. Even the S&P 500 is here, around a negative 13% return and a 22% standard deviation. So we have a Sharpe ratio of negative 6.6. Your maximum Sharpe ratio will be here, 21% return and 26% standard deviation. But even if you just have picked OHI, you'll have achieved a 25% return, although lower Sharpe ratio. So seems like the sectors all around did pretty bad. Did extremely bad. Only three names, OHI, IRM, and PSA, outperformed the S&P 500. Here's your expected return. Oh, LSI 2, and no, PLD didn't. So only four names outperformed. So in theory, it seems like it's not good to really invest on REITs. But we're going to see the specific names of why they did so well, and why we can look when we want to invest in this space. All right, we're going to start with IRM. It's Iron Mountain. It's a REIT, of course, as we are seeing, but in the sector, it's in real estate and construction. And this company is very interesting. If you work in an office, you will see that all the trash bins for paper go there. So basically, it's secure record storage, or for information management, or secure destruction. They also have a lot of asset lifecycle management. So it's a very interesting company. Yeah? Kind of a boring business, and boring businesses usually do pretty well because you don't need much. You're just very operational, so you just grow based on volume. So PE ratio at 31, and your dividend yield at 4%, 4.71, almost 5%. So it's pretty good. This is the key. We want to see the financials. Revenue was stable in 2018 to 2019, drop in 2020, right? Of course, the pandemic. But then in 2021, it went up by almost 8%. And then Here it went up by almost 12%. So this year the cost of revenue also went up, but your revenue, when you go up 10%, that's when you really have your margins, and then your gross profit also grew almost around 10%. So although your operating expenses are going up, they're not going up as much as your revenue, and you can see the margin. So same as Caterpillar, for example, we saw the earnings immense way of growing your business structural revenue and keeping your cost of revenue, and also your interest expense, which is where we need to look at rates. It has gone up, but again, if you're keeping your revenue up and your interest expense is not going down, because you don't need much financing in this kind of business when you're just secure, when you are providing asset lifecycle management or secure destruction or R destruction and logistics. So um, this company really helps businesses to bring light to their dark data, enable customers to unlock value and intelligence from their stored digital and physical aspect. So it's a very simple business. So you can see net income going up, and that you can also see that in the return of equity, right? So you can just completely review that, and then we want to see also our next is in healthcare. It's based in Maryland, and you can see again a small, pretty relative good P/E ratio of 18 and a dividend yield of almost 8.40%, so 838%. It's extremely high. Your profit margin is almost at 42%, so it's pretty good. So let's look into the income statement, see where we got. So basically, this is more for long-term healthcare industry and primarily skilled nursing and assisted living facilities, as the population of the US now is around 41%, is the 41 years, sorry, is the median age. More and more nursing and assisted living facilities benefit from this. So you can see revenue went down from 2021, but it's still higher than the previous years, and your cost of revenue is going up too. So in this sense, even though your net income is not making it better than last year, the market likes it because you are keeping your interest expense down. So it's meaning you don't need to finance. So, and we're going to see the trend when you are able to keep your interest expense down in a rising rate environment. You see how it benefits, right? So how it goes to see that the REIT is well managed, and it's it's in a boring business like assistant facility. So we know your net income went down. You can see high dividend yields, and this is, I think, what the market cares more about in this kind of investments in REITs. Your interest rate completely down, and also you also have other income, which brings the income before tax higher than the previous year. So it's all from knowing how to manage correctly. And then we're going to see Vichy, and we'll have to see an overview of how Vichy is doing. So these are the three reigning stocks. It'll be impossible, really hard for a manager to just pick these three and have the best portfolio, but I just want to see why it happens. So Vichy is an experiential real estate investment trust that owns one of the largest portfolios of market lending, gaming, hospitality, and entertainment, including the Caesars Palace, right, in Las Vegas. So big money. You can see it's in New York. Market capitalization of 30 billion, P/E ratio of 330, and here's what we matters: dividend yield of 4.78, and your profit margin at 35%, pretty high. I think the margins are just what the market wants to see. So let's see. Let's see their financial statements. Total revenue just crushing it. Look at this. From 2018 at 800, and dropped a little in 2019. Went up even during the pandemic. It kept going up around almost 20% during the 2021, and it completely went ballistic, right? Almost more than 30% increase in your total revenue, and your cost of revenue didn't even go up as much, right? 70, so your gross profit completely almost at 50% raise. And here, what we care, interest expense, basically not going as high, right? This is what 30, this is what like 15%, but if your revenue is going up almost 30%, so your interest expense is not doing too bad. So very interesting, right? How you can just completely get your revenue up, although the net income went down due to well, your income expenses. But here, yeah, we just want to see total revenue is just completely going and going up. So I think this is what it did. But in essence, it's just really hard to try to beat the market. So we want to make sure. I think, yeah, the REITs are good, but I think at the end of the day, the regular Vanguard 500 investor, even though it hasn't done that well this year, it will have done better than just investing in REITs. Although if they had picked these three games, they'll be big in the money. But I think, as we recommend, I think the markets, even though in drawbacks, they are efficient. So this is what we want to see. Not much of an alpha in the REITs unless you're really good at allocating only these three names and not the rest. So stay tuned for more. Don't forget to subscribe. Thank you.